welcome to Umbrella Saturday. Basically, Umbrella Saturday is a webinar where we basically bring partners, founders, investors, advisors to come speak to founders around different topic areas. Basically, just exchanging knowledge, deal sourcing. This is an avenue for investors to also source for deals. So what we basically do as well is bring professionals, operators, investors, everybody under one umbrella, and then just sharing real life experiences, well curated topics, to be very honest. This myself, Ayola, I have over 14 years experience. I've worked across various fields, from marketing to advertising to, you know, finance, and then currently investment. I run a business called Umbrella, basically just connecting African founders to investors and advisors. I've worked in all these companies from SYU to Spice TV to OPay to Patricia, where I was head of marketing. I've run my own business for over 6 years. To mention a few. Emerson, I'll just get back to you. I can see your message. I'll come back to you much later. Who is this Umbrella Saturday for startup founders seeking clarity, mentorship, access to real world experience, hear from real founders who are building, hear their stories, and then hear their experiences as well. For investors who are also scouting high quality verified African founders. At all stages, ecosystem operators from VCs to the likes of them. And then you also have corporate partners and brands who are looking to tap into several ecosystem. We also do a lot of connections with brands to founders. What's in it for you as a founder? There's access to industry expert and actionable insights, free platform to pitch your ideas and receive live feedback. And of course, exposure to investors and key ecosystem players. For investors, the last time webinar we had a few investors on the call, very quiet, didn't say a lot, but also have done some outreach to me just based on their interest to several founders. So I take it that introductions are opportunities to just pitch your business as time goes on. And then of course we have speakers who use it as an opportunity to sell partnerships. So there are founders who would also come on the call and speak about their products. They're looking to scale and also acquire more users. Some of their users might also be on the call, depending on the industry. So, of course, that's also an opportunity for that. Why should you be a part of it? Of course, Umbrella itself is built on trust and created, vetted experiences. We're founder first. So we look at founders and give every founder a voice. That's what we try to do. And then basically it's an avenue for deal sourcing. What makes Umbrella Saturday different? We are community powered, we're data driven, and a lot of things that we do is building our data in public. We also a verified pipeline. Just yesterday we had a deal room in Kenya with some Kenya counterparts of ours, just putting in their deal room for them and sourcing for right investment. And then I remember that someone was speaking about clean energy. And please just remind me after this call. I would love to do an introduction to someone who is also building something fantastic, thinking of getting into the Nigerian market. Is in the DRC, Congo, is in Congo, yeah, DRC Congo. He has solved some energy issues in Congo and is trying to expand into Nigeria. So maybe you guys can speak partnership and patents, and then you can scale up. Multi-stakeholder experiences. Of course, you have different people with different experiences, and we bring all this together under one umbrella. So it's not just a webinar. For us, it's one of the most reliable digital gateway to early stage startups or even growth startup. It's a deal sourcing experience for us and also for our partners. And of course, you get expert insights and startup investor matching, which also happens. We have a deal room. So from part of the conversations, there will be a deal room sessions where you have heart-to-heart conversations with the speakers, and then they would also tell you what you can get from their services. So welcome to Umbrella Saturday. Our speaker for today is available, is being on the call. His motto is always being early. Ayo Akindele is always on calls with me as early as I can ever imagine. He's there, he's ready to, share his experiences. He's been in this industry for a while. He's worked with the VCs, he's had experiences working on financial projects. And today he's going to be taking our visions to a stage of valuation where we understand it. And I'll tell you for a fact that I've seen um, situations where investors turn down deals because the valuation or what the founders think that their company is valued at is just an out of the world figure. And then investors start to narrow down and ask questions, right? And we all agree that we think that we are worth it. So if we are worth a lot, right? So because the idea is great, the market size is large, but to be very honest, there's the right way to do it. So I'll just welcome Ayo Akindele to the floor. He's just going to give us a brief background about himself and then go right into it. For questions and answers, the way we would like to do questions is while Ayo is speaking, if you have a question, you want to ask him something on the spot, put him on the spot. You can just raise up your hands so that we have it in an orderly manner. If you also don't quite understand certain things while he's speaking, please, you can also just raise up your hands. And then we take it at intervals. And then after that, when Ayo is done, there will be a deal room where board would be in the deal room, which is a company that Ayo leads, just speaking to you about their products, their services, and then how founders on this call can enjoy those services. All right, so thank you very much. Ayo, are you ready to go for this?
Yes, I am.
By the way, you have a great voice. Your voice is commanding. Let me be honest with you, Ayo. You're welcome.
Lord, thanks. Thanks, Ayla, for the introduction. Hi, everybody. It's good to be here. My name is Ayo Akindele. I have about up to 5 years of experience working in the venture space and, working and investing in startups across diverse sectors. Currently, I am a strategic consultant. I work in startups advisory, where I work with early to growth stage startups in Africa to scale, engage, raise money, and all that. Right. So that's what I currently do. Uh, and I run Board. Board is a strategy consulting and financial advisory firm dedicated to early and growth stage founders in Africa. Right. Now, up to what I was speaking about, uh, from vision to valuation. How do you prepare investor-ready financial models for your business? Now, there are so many factors that go into how you can prepare for a business or how you can position your business. But as we start, I would just like to get to know the knowledge base of my audiences. So, does anybody want to help me understand what you would mean when I say valuation? When I say you want to value your company, does anyone else just like let me know what you think it means? Yeah. Uh, Feel free to speak directly.
All right, anyone wants to go? Or should we just call names? We're all trying to raise funds here.
Okay.
All right, go ahead.
So I valuation is sort of like this determining the market potential of your company, and and that considering what it's worth, and that you sort of like um determine the based on the revenue or potential revenue, based on the market size and um financial models of the company determine what it's worth and to investors, and then that allows you to raise funding, and based on your valuation and the funding you're raising, you get a percentage of equity in your company. That's my understanding of valuation.
Okay. Okay, thank you for your follow-up. So now from an investor perspective, let me break everything down. When you build a business, when you build a product, I work a lot with investors. So first thing investors are looking at is to determine your valuation. There are factors that investors look at. First thing they look at the market opportunity. What's the market opportunity of the product you're building? How large is that market? How sizable is the market? How relevant is that market going to be in, say, 5, 10, 15 years from now? So the long-term sustainability of that market, right? Uh, then you get investors looking at the product, right? How much of the innovation behind the products is long-term sustainable? How much of that innovation is novel? Is there a unique selling perspective? Right? Where you could produce that, okay, this product probably not get launched as a feature by a larger company or go out of markets. So what in building companies, you have to understand that the markets, you have to build what the market needs, not just what the market wants. So that's a very important factor. It should not just be what the market wants, but what the market needs at every point in time, right? Because especially they have fun markets, right? A place where a lot of cultures, preferences, tastes are changing every day, right? So I mentioned factors, market products, then team, how much of operational experience does the team have? How much of financial acumen they have, how much of entrepreneurial drive, which resilience they show as regards building a company. Now, looking at all of this, all of this now comes into how we determine valuation. Now, I'm speaking from the non-intrinsic factor. Most times we have factors like financial model. I will get to that later. Why is the financial model very important in engaging investors? Why do you need to show the financial model and say, oh, this is what I think we've been able to get what? But I'm sure I get that. Looking at all factors I mentioned, it all boils down to something called venture backability or investability. So most times, your product can be very good or your business model is very good, but is not venture backable. So most times when you don't get funding, it's not because the business is not right, but it doesn't um you know um tally the thesis of that investor. So at most times, for points in time, you have to build a business towards investor backability or investor readiness. Now, let's go into financial model. Why would you need a financial model? Um, what's the financial model? Now, a financial model is a projection of your a financial model covers three things. Firstly, it covers the potential of the growth trajectory of your business, right? It helps you to spread out your financials projected over a period of time. Now, and third thing it does is it helps you put your business in numbers, right? Now, every business has three things. Every business has an income statement. Every business has a balance sheet. Every business has a cash flow. Now, what the financial model does is projects all that, helps you build a schedule, helps you build a lot of assessments that we do to help anybody looking to understand how much of long-term um, sustainability. I keep saying sustainability because it is very important to have a business that is sustainable long term or a business model that's sustainable long term. So when you are building or as you build, you have to understand how much of innovation of this is sustainable, how much of um, long-term sustainability does this business have, how large is my market. All these things come down and trickle down into what we call valuation, right? Now, when we say valuation, right, for any investor, there are two ways investors look at valuation. The first way is a DCF. Now, a DCF is called a discounted cash flow type of valuation. Now, for a discounted cash flow, what that does is, now let me give you an example. If I say, for example, Apple, if we say Apple is projected to be $10 trillion in maybe 5 years, that's fantastic, right? Any investor will want to jump on that, right? But today, they're worth 2 or 3 trillion, right? That 2 trillion they're worth is better than that 10 trillion. Because at the end of the day, they might not even get there. Anything could happen, legal issues, and the power. So the 10 trillion they're worth now, based on all factors we've seen, is very much better than that projected 10 trillion. Now, 10 trillion projected is fantastic, it's good, but it's a future projection based on if it's now in Excel, we do something, we say an if formula. So we say if X becomes Y, then yes Z. So that's how we look at things when we are modeling. It's always an if basis. If all things go well and all that. And the beauty of a financial model is it helps to because for any investor, they want to get as little risk as possible. They always want to de-risk their investments. So at that point in time, you are showing them a risk assessment, you're showing them an FX schedule, you're showing them for some market like Nigeria, right? Where as a joint 2024, if you invested $100,000 in a startup as a January last year, by June last year, the worth of your valuation has become maybe 40K or 50K. So it means you've probably lost you've probably lost 50% of your investment just having invested. So FX is a big problem for any investor. But if someone that already captures that, right, it helps you understand how we go inflation, layer, regulatory risk, and all that. Now, that is the beauty of a founder like goes to an investor with the financial model and valuation analysis. That's the difference another one who doesn't go. Because at that point in time, any investor is not focused on your product. I'll say it again. Any investor is not focused on your product. As good as it is, that is very good. But any investor wants to ensure that the business entirely is good, right? Because we've seen startups where products fail, but they are still able to pivot to another one and keep moving. So there's importance of the business than the products, right? That's why, like I said before, the market the business is playing, how relevant is it? How large is it? The product innovation, what's the unique selling perspective that product can have, right? At that point in time, you're saying, oh, this is okay, fine. Are we saying that so we intend to expect? So these are all the things that come up to play at every point in time. Now, when you have a bit of that, right? I'll go back to this year. I gave you the Apple analogy. Now, if I'm going to value Apple, right, today, use the financial model, use everything, and I just valuation analysis. A very good way I'll do that is in this year, a discounted cash flow. Now, what does a discounted cash flow mean? It means that I'm projecting future cash flows, FCF, future cash flows over a period of time, or even towards the terminal period, and discounting it back to the present. That's how I get a version of a company. So while I have brought up all the intrinsic values of my financial model and all the extrinsic ones, with the brand, the products, the market size, and all that, and I say, oh, I think this is going to be, maybe you say, maybe you're building a fintech, and we say fintech is going to be worth about $60 billion in 5-10 years. And based on your model, you can capture maybe 1 or 2% of that market. So 2% of that is what I expect it to be in the future. But at that point in time, 6 months from now, you might never exist again. They might just have So investors already have that in mind that this is going to happen. So what they do is they project those future cash flows and they discount it back to what you're currently worth based on every other factor that they look at. That's how we get most valuation of companies. And then other ways that you look at valuations is something we call the Beckus method. Now, for the Beckus method, that's mostly an extrinsic negotiation between you and the investor to say, oh, hi, this is what, based on everything we discussed, what I think you're worth. So it's just like an off the backhand kind of discussion or conclusion. Now, I've spoken to, because we're talking about valuation. What's the importance of that model? The importance of that model is it helps investors see the practicality of your business in numbers. Because most times, they say something that most times we in finance, this is something we say profits is in Excel. Right? Profits is in Excel. So when you see those fine numbers in Excel and then in reality it's not looking like that, that's really how it is, right? But having a pictorial representation in numbers, when you see, because most times a lot of founders get excited, it's going to grow very fast. But when you just start in numbers, and then you say this is what I think, you see the practicality of it, and for any investor too, you're able to, and then you're able to cover any extrinsic or intrinsic risk to your business, to the business, right? Where you're able to analyze that in numbers. Now, what the financial model also does is it analyzes the ratios like liquidity risk, solvency risk, capital ratio risk, and all that, and helps you understand how liquid your business can grow. So financial model tests for three things. It tests for liquidity, how much of liquidity is your business supposed to have? Because when you look at all the three statements, the income statement, the balance sheet, the cash flow, because the financial model, the job of a financial model, a full three-statement financial model models all three statements. But the most important one to look at that we focus on for valuation is the cash flow. Because the income statement looks at how revenue is coming in. The balance sheet looks at your assets and liabilities. The cash flow looks at how you are spending money. So in the cash flow statement, we have three things: cash flow from investing, cash flow from operating, cash flow from financing. So what assets are you financing with your money? What investments are you making with your cash flow? What operational expenses, OPEX, are you making with the cash flow? So when you look at all these three things, that is exactly what the cash flow, and that is what we use when we are determining the valuation of the company. Because if we want to look at the financial health of any business, we look at the cash flow. We'll be able to ascertain what I'm trying to say is the relevance of the income statement and balance sheet relies on the cash flow. It's so important that if I'm in a disaster today and I'm supposed to value a company and maybe they tell me that, oh, we can only give you the cash flow, I can still produce something when I see the cash flow. When I see the cash flow, and that's why we say cash is king. So for any valuation that anybody is doing, it has to rely so much on the cash flow, because at that point in time, you are showing how much of cash prediction that you're going to have and how that will reflect into your valuation. And why do we look at that? Because at the end of the day, cash is what you are spending. Cash is the exchange of value. So when you have assets, money is coming in. If you make a maybe 100 million naira in revenue, what's your profit at the end of the day? Maybe 30 million or 40 million after paying tax, after paying every other thing. So profit after tax, right? So most time when you have like the EBITDA, so in the EBITDA, when you have like EBITDA is called the earnings before interest, tax, depreciation, and amortization. I won't go into all of that because that's a more technical thing. But the EBITDA is the revenue, right? So when you say, we made 100 million naira this year, fantastic. That is your EBITDA. But at the end of the day, how much is the business taking home? Now, earnings before interest payments, tax. If you're a corporate company and you're making more than 5 million naira, you are liable to pay in Nigeria, liable to pay over 32% in tax of your revenue in tax, right? Depreciation. Depreciation means that you are accounting for the depreciation of your assets. If you buy, maybe you buy a car, or maybe you buy a computer, all those things, assets of your company, they depreciate year on year, right? Those are more accounting techniques, so I won't go into them, right? Amortization, how do you amortize your assets? When you got all these things and you are spending money on them, you're spending money on deferred tax liability, you're spending money on paying, you're spending money on credits you're taking from customers. At the end of the day, your profit after tax, remember I said, now, PBT is the same as EBITDA, but profit before tax, right? You have paid, but the real explanation that I'm making is your profit after tax. Your profit after tax becomes your operating revenue, right? Because at the end of the day, you make revenue minus expenses becomes now I don't want to go into all those things, right? I'm just going to help you understand how the importance of the financial model. That's why I'm going deep down into how it trickles down. It's all the trickle effect. Now we go into the balance sheet, look at all the assets and liabilities, and then come to the cash flow. There's something we call circular references. The links between income statement, balance sheet, and cash flow. What are the links between the three of them? How do they all trickle together to help you understand the valuation of your company? So that's the importance of it. Now, 5 things that a financial model does when you're meeting with an investor. Because when you're building a financial model, you can also explain the valuation. It helps the investor understand the risk to your company. Because at that point in time, your company is being expressed in numbers. We are not talking potential. We are talking reality. That is a financial model. The financial model shows you the reality of your business, not the potential of the business. Because it has the potential to grow very fine. I want to see this in numbers. And when you look at like tools, we use Excel numbers, they don't lie, right? It helps you become even conservative in how you value your company. So at that point in time, if you're saying, oh, you're valuing this, because founders tend to get excited and sort of overvalue. What the financial model does is just helps you understand the conservativeness of what you're building and understand how much you need to grow, right? And what do you need to do? And even what the financial model does is it can help you build your cap table. Where do you want to be when you raise your pre-seed? Where do you want to be when you raise your seed round? When you want to be when you raise your Series A? When you want to, at that point in time, you're already understanding your cash flow journey or trajectory, right? Where you're understanding how much runway you need to have, like it is practical. So the first thing is practicality. The second thing is risk. It helps any investor understand risk. So when you build a financial model, you are being practical with your projections. You are being practical with your understanding of the business, right? And when you can show an investor how your business can help them de-risk their investments, they will show interest. That means that your business is now what I said before, venture backability. So in venture capital or private equity or any kind of investment, we don't just look at the business itself. We look at the thesis of that business. How much has this business shown that it is venture backable, that it is investment ready? And to be investment ready, you need to have a financial model and valuation analysis, right? So the third thing is it shows the conservative potential of your company to grow. Look at Money Points. Money Points started in 2017, so they are a unicorn. They already knew they were going to achieve unicorn stage. That's when they started. So the first check they got could already see the journey to unicorn stage. That is the importance of the model. The first check they got, the early stage checks they got, going forward, and when an investor exits, they'll go back to the model, update it. That's its importance. The model you build today as an early stage founder will continue to be relevant to you in 5, 6, 10, 7 years, 10 years, because it is guiding you. So the third thing I wanted to say is it is a guide. It guides your projection. It guides your operations. You know that we cannot spend more than this. So we cannot spend. That is what the model tells you. And at any point in time, most time the models that I build or that we build at board, we focus on switching tools where because most time the investors that invest in you invest in USD and they expect you to report your earnings in USD. So you see that in a market like Africa, you're already backward because you are dealing with FX, you're doing all these things, right? And by the time you feel like, I made a lot of money this year in your local currency, by the time you report it in USD back to your investors, it might not be what they're expecting. So investors already know that risk already when they're investing in African startups or markets, right? But you have to show that you understand these things. The fourth thing here, the fourth important factor for a financial model and valuation tool is it shows the quantitative analysis of your business, right? You're able to quantify what the business is. You are not talking from the qualitative quality of the product. These things are partnership. These are things that will get an investor interested. Because now, when an investor is interested, I'm raising money for a startup now. They have their product is very good, right? The market opportunity is fantastic, but they were also able to show how their financials are doing. They've done about 800K in 6 months. That's about 133K MRR. There's no investors look at things like monthly recurring revenue, annual recurring revenue, ARR, MRR. They have a threshold they have to follow that, okay, we expect you to be doing 30K, 50K, 10K for early stage, 20K for early stage at that point in time, right? GMV, gross merchandise value, how much total revenue have you made in your company, right? How much of active customers you have, and all those things, right? This is a company that's done about $300 million GMV. They are already doing 800K in revenue in 6 months. So at that point in time, you could already see any investor will be excited to speak to them because beyond the potential of the market itself, they are already getting their hands dirty. So when I was building that model, one could already see that this is where we expect these guys to be, right? And that's the importance of modeling. So that as fast as you are growing, a financial model helps you guide your growth. So practicality helps investor de-risk, serves as a guide, quantitative analysis are 4 things. The fifth thing, and something I find very important, is it shows that you as a founder understand business. Nobody wants to invest in any founder that does not understand his business. I don't want to go into a call with a founder you are telling me that the CFO will tell me this, or the CFO will tell me that. I will lose interest in it, right? Because at the point of the time, as a founder, you are the chief salesman. So you should be able to walk me through the financials of the company. You should be able to tell me that, we're already doing this in revenue, we're doing this in profit, but bother these customers. Even if you are the engineer on the team, it's still your job. So when you build a financial model, everybody on the team needs to know what's going on. So that's what I mean by it helps every investor understand that you mean business and you understand what you're doing. So these are like the major factors, right? And how it trickles down to your valuation, how many investors will be interested in what you are doing, how many investors want to come in. Because at the end of the day, any investor is a growth partner. And a growth partner will only come in when you can show the trajectory of your growth. When you can show your growth trajectory. If we say things like modelers are magicians, I could conservatively agree because it helps you understand step by step how much you are growing. So that at any point in time, if you face crisis or risk or market, you can go back to the drawing board, go back to your strategy and allow that to guide you from a financial and quantitative strategy. So that's really what it is. I'm very happy to be in this session because it helps me understand how much we can help early stage founders understand how quantitative they need to be, even at that early stage, right? Even at that early stage, no one is sparing belief or bets anymore, right? Because of how the market is at this point in time, you have to show a lot of quantitativeness, right? So I'm happy to take any questions, and I'm also happy to.
Ayo,
Yeah.
Great presentation, right? I just want to go in very fast, right? Because I know there's some founders on this call at any stage they are wondering, and the first question I have for you, Ayo, is how should I think about valuation, right? When I have little revenue but strong traction, how should I even approach valuation? How should I, tell the story of my valuation?
Great, great. Now when you don't have a lot of foreshore or a lot of foreseeing things on your financial, the way to approach valuation is from an extrinsic approach. At that point in time, we are helping them understand the market size. And you're saying we believe that we can capture this the market size within this period of time. If you can show how much your business can grow with the market, and that is the importance of a unique selling perspective. A unique selling perspective is something that it is you and you alone, right? Like the market now, if the market is growing very fast, the market needs your product to grow. So when you can show how much you are growing with the market, we can then calculate your valuation based on the market approach. And that's why for public companies, we do something, we do a comparable analysis. Right? For a comparable analysis, we look at we compare it to other valuations or other companies that have been acquired or other companies that are in that market, and then we look at now for companies that have not really made any much of revenue, we look at other companies in your sector who have probably been acquired, who have probably merged, and then we use that to discount back to project the valuation.
All right, thank you, Ayo.
So these are ways we all just look at all these things, creativity and everything like that when there is no foolproof. Especially for early stage companies, because for early stage companies, you have to be very creative. Yeah, you have to be very creative to how you look at things. Yeah.
Thank you, Ayo, for that. Thank you for that input. I see hands up, but before those hands go, I would just ask the second question I have for you, Ayo. Are there some practical ways to justify valuation to investors when operating in an emerging or undercapitalized market like Africa?
Yes, there's so many ways to look at it. For a foolproof, right? A lot of investors that you are talking to already understand the risk of working in an emerging market. What they need to see is the fact that your business matches what they expect to see. Because any investor who invests in the emerging market has already built their thesis around what the market is like. So a Silicon Valley investor, his thesis can never be the same as the investor in Kenya or investor in Lagos or investor in South Africa. The markets are different, right? So the practicality of it is already different. What you need to show that investor or prove to that investor in your valuation analysis or valuation story is to show that. Now let me explain. Let me just give you a very fair approach. The investor you are raising money from also raise money from someone and also have to return money.
Right? You're speaking so VC now, right?
What's it?
You're speaking VC now. VC has
yes. I'm trying to show you how it trickles down based and then come back to your question. The VC you're investing in also has to return money. So you see that it's a returns game. At that point in time, when you're speaking about your valuation of your model and speaking to an investor, you have to show them that you understand how your business can help them return money. It doesn't have to be expressly said, but by the time you're speaking about your business and what the metrics are and everything like that, the investor already understands the long-term projection of your business and how much this can help him make money. And those market factors of values or anything like that. So that's how you can approach it. Understand, and that's the importance of understanding your market. Because most times the investor is able to understand your market than you do. So they will be testing for how much you understand the market, or if you can show them the market opportunity. Because any investor will look at the market opportunity. When they can't find a lot of, especially for early stage, we look at the market opportunity and founder strength and all that, and then we look at the financial models to project how much can be made, right? So that's really how it is, really, right? Just speak a lot to the market opportunity, help the investor understand, because I bet you, the investor you're speaking to understands your market than you do. I'm not speaking from a product perspective. I'm speaking from an investor operator perspective. A lot of investors today are ex-founders, they're ex-operators. So you can't go to them and maybe bamboozle them with some, so you have they have to see the practicality. They have to see a lot of that. So give me a minute, please.
All right. While Ayo is coming back, since it asked for a minute, let's allow him drink some water. I think he's done a lot on this call. We would have Sadiq. After Sadiq, we would have Emerson, and then Faith, Uzo, and then Jide Martins in that order. That's the order of how I saw the hands raised. So, Sadiq, before you go, let's just confirm that Ayo is back. Ayo, are you back?
Please just give me a minute, please.
All right, okay. We would wait for a minute. Apologies for that, everyone on the call. If you have more questions, you can just place it down on the chat session, or you can raise up your hands so that you can have like direct conversation. Follow, I see your hands up as well. So you go after Jide Martins. But I think this is a very interesting conversation, just standing in while Ayo is not here, because you know, you are a founder, you are worried about building the business. In your head, what you're building is going to be the next unicorn out of Africa. You know, I had mentioned market opportunities. We see the market opportunities, right? We've done our research, we've done our market analysis, we've tested the product out there. We see that there's a need for the product, you know, but oftentimes when you go on calls with investors and you get closer to fundraising, the next thing you start to hear around is valuation. What's the valuation of your company? How much revenue have you generated? So what's the valuation? You know, and I have said so many things around what investors are looking at. You know, very key for me is the scalability of any business that you do, right? Take it out of Nigeria or out of Kenya or Rwanda or anywhere in Africa. If they take that model and they say, you know what, we're taking this model into the US, will it scale in that market as well, right? It's very, very important that we look at it from that perspective. So I would just also, while we're still waiting for Ayo to be back, maybe some founders who have had experience around valuation conversations with investors can also just, maybe just one or two people quickly unmute. And then while you still hold the question for Ayo, Ayo is the valuation expert, is a financial expert on this call. A lot of time I also see that founders leave all this to their financial guys to do the Excels, and then they run them through the Excels just for the knowledge know-how. But one of the things that Ayo has said as well is that we are the chief salesmen of our business. We should know how to, you know, speak the numbers. If you were like me in the uni days or in secondary school days, where you know you're not a number person, you are probably an arts or arts student, you know, per se. Numbers are not your thing. You will struggle, right? But again, practice makes perfect, right? Have pitches done with your team, have your financial person run you through certain questions, possibly get on calls with, you know, people who are like advisors in the financial space, where they can ask you the right questions, get you prepared for it, right? Never go in front of an investors and get embarrassed in the valuation of your company, especially when investors will now say, oh, you're being unrealistic with your valuation. To win that investor's trust back takes a while, to be very honest. It's hard, you know. So I would let anyone who has had investor experience around valuation or conversation with investors, just want to share one or two. Let's take some knowledge from it while we still wait for Ayo.
So I would like to go first.
All right, that's fine.
So yeah, so far so good. We have been fortunate to pitch at some investor stage, not too much. I think just one or two. Unfortunately, they did not even have any flaws in our presentation, and they confirm everything we are doing is right. But where most of them are always at are this part of financial projection and valuation, right? And yeah, we are in the public transportation as a service space. And those who are doing what we are doing are like Shuttle is the closest in terms of the private space, and then the BLT in terms of the public space. But Shuttle, they are heavy assets in terms of, you know, owning buses, for coastal buses, and the likes. Do you get? And based on the arrays from the United Nations and the likes, is what we can actually estimate our valuation against. That is one. But compared to Shotler, BLT, yes, BLT as of last year generated 20 billion naira. Yes, they generated 20 billion naira. Now, the question that comes to us, okay, if we want to do our valuation, we can't present to a valuation of a startup. We just started in this space. We are doing it all. Like, we started on the street of Mina. We started from Abuja to Mina to test all these valuation, and then we did some in Lagos. We can't practically give you this valuation that, okay, this industry is exactly this amount. But based on these people, BLT, based on Shotler, this is the estimated valuation. You get, but they are not convinced enough. Like, it is going to be more than that, or it is not up to that. Do you get? So how do we balance between attaching a valuation to a sector like this, considering that at one side it is a private company who owns all the assets or are collaborating with bus hiring companies and the like, and on the other side, it is a government-backed sector. BLT are backed by the Lagos state government. They are being funded. Just Carry-Wise and maybe Touch and Pay and all these other stuff are the one running the hardware, the card, and the likes. So how do we make a balance for this valuation for the investors? That is one. Two is on the financial projection. Based on the revenue we earn, is what we projected. Okay, based on this revenue, in the next 1 year, then a judge is telling us that you should do for 2 years. We are not a soothsayer. We can't know what is going to happen in the next 2 years. What if we forecast that things are going to work fine and the government policy just change everything and it's not going as well? So how do we balance these old things to make sure that that part works? Because that is our major focus now, financial projection and valuation.
Thank you, Sadiq. I wanted you to open the question for Ayo, but Ayo,
I'm back. Yeah.
Ayo, you cannot go and leave me on this hot seat, because
no.
the questions you are going to receive today, I hope you're ready for it. Because I hear what Sadiq is saying, right? One part of it, the government has invested. The other part of it is a private sector who has raised money, and they're not even playing in his space, right? So how does he, do the projections, but and then value the company? And again, the investors he's been speaking to are now even asking him to do like a is it 2 years valuation?
Sorry, just to understand what you're saying. Sorry, do you mind recapping that question? That's just one question again, so I can understand the particular context you're coming from.
So I think you have the floor.
Okay. So here is the thing, right? We've pitched at 2 to 3 or investment stage, and all the judges give us an applause that we are doing a very fantastic job and all that. There is no
Emerson, you can just unmute yourself. While we're waiting for Emerson, let's have Uzo. Uzo, are you there? You can just unmute yourself.
Hi, can you hear me?
Yes, we can.
Okay, great. Sorry, I had my earpiece, so I couldn't know if I was unmuted. So my question is around pre-seed, pre-revenue. Now, how do you get valuation for that? I know, so I kind of, had a ballpark figure because of the founding team, the market size of our products, and potential for growth and all of that. But most, investors were like, well, right now we don't really care. Well, that's one particular investor said, we don't care about the valuation for now. But then towards the, so we continued towards the end. They were like, oh, they couldn't bear the risk alone. And I didn't understand, why. I would have thought, okay, maybe because we're trying to raise 1M, if 1M is a lot, I need a second VC to join, that's fine. Or maybe reduce, what you can, what's fair, and then, we seek other investors to complete the round. But I just wanted to understand why that was the position. They were fine with the deck, they were fine with the product, they were fine with the team, they were fine with me as the founder, and everything kind of checked out, except that, they felt like the risk was too much for them to bear. And also for pre-seed, pre-revenue, how do we position ourselves so that we're I would say we're kind of sort of investor ready, but maybe not, depending on who the investor. So it'd be good to hear your perspective and just some pointers for us.
Okay, great. Thank you for that. Now, for pre-seed revenue, right? Because we also do models and valuation seed revenue.
Yeah.
At that point in time, what we do is mostly applying sensitivity based on what we see. What we can do is for that's at that point in time, right? Guided by what we did to have it to build up. That's the say we can go about this. I do.
Ayo, I think we're struggling to hear you, Ayo.
Yes.
Ayo, I think
Sorry, can you hear me now?
I think maybe if you're using an earpiece, maybe you just try to just speak to us directly. We struggle to hear the point, and I'm sure a lot of founders on this call actually want to know how you approach that. So let's hear it audible. Yeah.
Yeah, I'm using my headset, so like, is it better now?
It's way better now. It's way better now.
Okay, great. So I was addressing your question, Uzo. I was saying that for pre-seed revenue companies, right, which are mostly what we find or are available in the market right now, a lot of early stage investors tell you, oh, well, we don't care about valuation, we don't care about dividend, but at the point where they want to invest, you begin to hear things like, you need to see something, you need to quantify something, you can't bear this. It's something that is important. The reason that they will tell you that they also have to do, so for the investor side, something called like a returns analysis, right? Where they can be able to punch in a particular number into Excel and tell them that how much you can make from this, blah, 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 if using the if formula and all that. So that could be why because now, so avoid a situation like that. What it means is you could have when you approach that kind of scenario, you see revenue companies. Most of the companies I work with are pre-seed, pre-revenue companies, right? Who are trying to like build models and value their companies. Now, at that point in time, they are using a lot of public data, right, to factor into the startup. So we are looking at what has happened in that market. We are looking at what is what is already has happened in the market. What's the public data available? When you can pick that on the back of that is where you're not, and then when you are not doing the modeling and validation, you're able to show that this is the source of the number that we used and everything like that too. So that at that point in time, at the end of the day, negotiation ends in processing manner because at the end of the day, like for pre-seed revenue companies, told before, they look at the founder strength, operational experience, what's the market opportunity, what is exciting. But at the end of the day, when they want to write the check, they have to go back to returns analysis. A lot of businesses have that thesis that they have to show a returns analysis. So if you want to avoid a situation like that, you can always model the business, ascertain the profitability and valuation, because even though you have not made $1 or using public data, right? Oh, this is what you're going to do there in the market. So at that point in time, you are using a relative kind of valuation. You're not using, you're you're not using an internal kind of valuation, because at that point in time, you don't have the numbers. You are only projecting. So you are using a relative valuation. For a relative valuation, you are using other companies. Now, when I say other companies are like you can be in a sector, right? And a VC can invest in you and a competitor, right? Because you and that competitor are competitors on the general overview of the market. But at that point in time, you might complementary or vanilla to each other. Maybe not selling the same customers, maybe not operating in the same space, even though you're in the same industry. So that's how it really works. Where for a relative valuation, you're looking at using the conservative approach to relate to trends in that industry, right? And how it trickles down to your own company, right? If you are building in healthcare, what are the major trends that are coming in now? How will it affect your valuation, right? So that's a way that one can approach that can people perceive where there's no data. Where there's no intrinsic data or where there's no internal data to work with, that's how we model it from a public standpoint using a relative valuation. Yeah.
Thank you, Ayo. Let's have the next person.
I'm sorry, did you understand my response?
Yes, I did. We had our financial projections. We projected all that, but I think for them they felt because we didn't have a license, so they felt we were high risk.
Exactly.
High risk.
Yes. Those are the trends. License, maybe there's a new innovation in that industry that can affect your valuation. But at the end of the day, looking at your valuation, it will be on your cap table. How will those things affect your own stake? Because you are the investing the same for stake in the company. So yeah, that's just what it is.
But I did factor the regulatory part in our discounted cash flow, and so I guess I think some of these.
Did you have a license as at the point when you get the check?
No.
That's high risk.
No license. All right, Ayo, let's have.
Thank you.
Thanks, Uzo. Let's have Jide Martins, who is next. Emerson, I'll come back to you.
Hi, Ayo. Thanks, Ayo. Can you hear me?
Ayos on this call. So which of the Ayos?
Okay. So I'm just going to go to a very, very basic question because of my background, right? And I'll just explain a little bit what my background, so that you understand why that question is basic. I'm a creative. I tell everyone I'm a creative first. And I built comic and animation industry from the ground up at a point in time when people didn't even think it was a profession. And I did it digitally. We've successfully grown the business. We've migrated now to animation and gaming. And like I said earlier, we recently just closed the $4 million deal with Universal Studios. Now, throughout that whole process, I didn't think about investment. I didn't really care about having investors, to be honest with you. And throughout that whole period, I was approached by shareholders time after time. The only reason why I'm thinking about now is because I'm creating a new animation arm, and I'm thinking instead of investing money from the other business, why don't I just get investors, because that's what everybody say we should do. Now, the question here is, throughout that whole period, it did not cross my mind to say, okay, I want to have a financial model. I want to do this. I want to do that. There are a lot of creators who are very passionate, who don't even, again, you're saying, I heard you saying earlier that let's be realistic. People look at the numbers. Let's also be realistic. There are a lot of people who are creators who have awesome products who are creating businesses organically that don't even know how to create a financial model in the first place. My question is, how do they, if they don't even have the brain capacity to, and that is a real fact, right? Where they're just focused on their creative work or whatever business it is that they're creating from the ground up, be you a farmer, a creative, an artist, a painter, a coder, and they're so focused on their work, where can they find the necessary skill to actually create a financial model? Where do they go to get the information to do that? How can they even define a financial model in the first place? I don't really have that problem, but I like to be an ambassador for the creatives, because I see too many creatives relying or being taken advantage of by people who are good at the business side of things. And I'm like, I want to point them to say, look, you should have this in mind. And hey, even though you're not good at it, get this kind of expertise. Get this, go to this place to get this kind of knowledge. Go and seek this person in this field to help you do this. What would you say is, how would you advise somebody who doesn't know how to, most importantly, doesn't have the capacity to be able to generate a financial model at any stage of the business, be it foundational or years in after they created a product?
Okay, great. So now this is a general question that we get for creative tech, inclined, actually creative, right? I was working with a gaming startup to our clients. This was one of the issues that came up to, where they were more focused on the product potential. You don't understand how that can model that. We should all always understand that the buyers have innovative products come out of business, right? Innovative products come out of businesses, and businesses themselves have a growth curve. And the reason why valuation as a concept came in is because of things like this, where you as business owner, you don't understand what you're doing. Now, remember that as a team evaluation, we're looking at everything to find identity. What's product potential? What's the risk assessment? What's the and that's why I mentioned the Becky's method. The Becky's method where it's just an investor that will just sit down and say, based on what I've seen, if you're valued at this, oh, I think I'm valued at this, and you can just get your choose based on what you understand the market. Now, when it comes to like helping them understand these things, what I do for a lot of my clients in that sector or in that space is I share a lot of resources with them just to understand the concept itself. Now, I offer that service, so they hire me to do it. But most times, I don't really like to join, except it is very necessary. I don't like to join founders, first of all, right? I don't want to ever do have an expert project. No. So I share a lot of resources with them. Read this thing, understand how it works, right? From a layman perspective, just understand how it works. When I deliver full model based on financial issue, information you share with you, your partnerships, your innovations, patents, and all these things. When now have a 30 minutes to 1 hour conversation call, right? I walk you through everything that I've built so that you can also walk anybody through it. So at that point in time, I'm bringing your expertise or your professionalism as a creative down to business acumen, business groups, business financials, and all that. So that's really how it is, right? There are always a lot of resources. Maybe and most times I mentioned that we want to hire a service provider like someone like me to build that model for you, so that you don't have come into a situation where you are reading something online and then trying to apply it and then run into potholes and all that. But what I always do, right, as a founder, creative advice is just seek for resources where you can also understand not the application, but the concept itself. The concept and why it is important. So that you can also, so that by the time you hire someone to maybe do the model for your evaluation analysis, by the time you're having that call with the person to understand what you're doing, easy to do. So the first time, now it's super powerful. You are able to apply what you know about your industry or your creativity or your business, and then still be able to understand or speak to anybody about your financials or your growth potential. It's always a good.
All right.
Yeah.
Thank you, Ayo. Thank you, Ayo. Jide, I hope that was helpful feedback. But just to also add to what Ayo has said, is understanding the basics of how those concepts have come to play. And I can understand you. I'm a creative as well. I started off doing designs, and now I'm doing business, right? So the truth about it is that as creative, there's the creative part of it, but there's the business of creative as well. And maybe just very few people are getting into the business of creative, which is where you are right now, and then I think Lawrence as well is also doing a great job there. Jide, you want to say something? I see your mic unmuted.
Yes, yes. Again, as you said, I am where you are now, right? But I want to, like I said, I speak a lot to the creative community. I know what to do now, right? But it's from, hanging out with people like you and people like Ayo and having them on board. But I do know that there's a critical mass of people who actually don't even know how to. And to be honest, they can't go into this kind of field. So I just want pointers to say, go to this organization, check this kind of material online. Do you understand? Meet this, because the one thing that has helped me is I've had agents and I've had agencies both here and abroad. Do you understand? I've
Yeah.
had professionals in different fields who I delegated stuff to, and they were essential in us being where we are today, the pivot to where we are today. So, how can I direct, especially Nigerian creatives, right? Where can they get this information? What type of, should they be looking for accountants? Because that's what they tell people, go and get an accountant. But creating a financial model is more than just getting an accountant. Should they be having business development people on board? This is stuff that they need to know from get-go, and not, oh, you need to just go and look for an investor, which is the popular thing now. And then you get in and then find out that you're confused, right? So I just want to know how I can guide them from
All
the
right.
get-go so that they don't waste their time.
All right. So
Just to what you said, today, I just wanted to share some final thoughts on that. So, like, when you want to do things like this, there's always a place for expertise. It's always good to consult a professional, right? Consult a consultant, consult a service provider. So you have an exhaustive. And now, when I read get an accountant, I always laugh, right? Because what you need is like what I felt when I work with people, I say I have worked with investors, I know what they want to see, I know how they want to be. So what you need to approach is a lot of consultants, professionals, finance professionals, investors in that industry of investor you're speaking to or anything. Because now the good thing is right, anybody can say, oh, I can build a model. But in time, when you build a model and then investor sees a model, that person or that consultant has captured maybe 85% of what the investor wants to see. It makes the conversation easier than just going to anyone. I think that's a mistake that a lot of creatives, a lot of people are not exactly should make. At that point in time, you have to the right person, that like an investor, professional, finance person. So I just wanted to say that, not just any account.
Thank you.
All right. To just add to that before the two other speakers go, there's something we're doing at Umbrella. It's called Capital School, where we are partnered with institutions, people like board. More like just consider it to be like your Coursera for founders, where you can go watch videos, understand the concept, take some courses, and then just basically get it out of the way, right? By understanding certain concept behind the business of even running a unicorn, right? What it takes to run such a business. So we are in partnership with TechSite and some other banks, and then this will also come out very soon. It will soon be hosted on Umbrella. We're still at the stage of shooting. And once these videos are out there, and it would keep addressing certain problems that we see within the ecosystem with creatives. Just thought to put it out there. So Jide, that's also a pointer. Another thing we can do is if you can organize the community together, we can partner with you and bring in these resources to come speak to the community. And then you can be sure that at least that knowledge can be shared from time to time. And this can be powered by Comic Republic, to be very honest, and maybe any other partner who is interested in working.
You beat me to calling you to discuss exactly what you just said now. So yes, I'm all over it. Thank you very much. I'm enjoying this so much, and I wish I had more of my, colleagues here. So yes, doing this for the community will be awesome. Thank you very much.
All right, thank you, today. Emerson, let's have you. I know Faithful. I will stop there. Faithful. Is probably waiting to murder me on this call. All right.
Yeah. Ayo, before we sort of go on, I have been seeing a question in the chat. So maybe I will read it out.
I'll read it out.
Okay, fine.
Anne doesn't want to speak to us, which is fine. So I'll read it out. Emerson, let's go. Emerson, you have the floor. We can't hear you. Maybe you want to check your mic, and then maybe I'll ask Faith to speak. Faith, you can go.
Okay, good morning, everyone. Good morning. So my question is about the current evaluation. So we're a startup company. We're looking for pre-seed funding. Though we haven't really directly got in touch with investors, but we've been going through some other mediums. And one of the questions we've been getting lately is, what is your current evaluation? Now, that's a very common question. Despite the fact that we have pre-seed, that question has already been brought up. So I would want to clarify what falls under the current evaluation. Based on my own research, I was able to put the company setup cost, which is the setup of, getting our branding ready, our website, paid subscriptions for certain services. And then I also added our current running costs, which is our day-to-day cost for the current project we're working on. And then lastly, I want to confirm, now while we're working on some projects, those projects actually have an asset. So my question now is, should we add those assets to the current evaluation? One, and those assets that are IP-based assets, should we value should we put a value on the IP? Because one thing I know is the current, I don't know, but the current evaluation have been a very big concern for us. Yeah.
Okay, thank you very much.
Sorry, Ayo. Do you want to give some
sure.
To the product and Faith, so that Ayo can answer from that background and not just. I know Ayo is. Oh yeah, but
okay.
What are you building?
Okay, so we're a game studio, and we're currently working on certain game in-house. There are not yet publicly known, but working on some certain game products right now. So we have like characters, we have characters, we have stories and all of that in here, like rich stories. We should also partner with a book writer to draw from some of their lore as well.
Can you imagine? If I didn't ask you this question, Jide and Laura would not even have known that you are part of them. All right, that's fine. Let's have you, Ayo. You can take the question.
Okay, so when I hear questions like this, I'm always I don't know if I could say conflicted or I find it a bit funny. Let me explain why. Now, when you want to raise money, right? You want to raise for your business. You get faithful, right? That's me, right?
Yeah.
Okay. Have you heard
faithful works?
What's it?
I said faithful tennis, but faithful works. Yeah.
Okay. Let's leave it at it. So, have you heard of the concept called post-money valuation? Have you heard of this? Have you ever
No.
Okay. Now let me explain that concept to answer your question. Now, when you want to raise money, right?
Yeah.
Right? Post-money cap is saying that you are raising 1 naira at 5 naira post-money cap. What is that post-money cap? Post-money cap is saying that
the price of the money you are raising now for the stake you are giving out, this is what you'll be worth when they want to exit or during cycle of that investment. Do you understand? So if you say you want to raise maybe $1 million, $2 million, and then from both sides, your understanding as a founder already helps the investor get involved. So if you go into a conversation with an investor without understanding this, you struggle, right? Now, if I say I want to raise $1 million at maybe an 8 million money cap, now my current valuation plus the $1 million that I've raised, right, become my valuation after raising money. So there's something called pre-money cap. So pre-money cap is what is your valuation before you raise that money? This is when the investor asks you, what is your current valuation? The investor is asking you that what are you worth right now, right? Before we give you that money. So that when we give you that money, you can then ascertain what will be your post-money cap. Post-money cap at that point in time is we're ascertaining your valuation after you have received money, or after you have raised money from us and diluted your stake and all that point at that point in time, right? So a lot of these things sort of conflicts, right? Now, when you talk about like when you want to ascertain your valuation, you can look at the market opportunity, you can look at the innovation of your products, right? You can look at the IP, patent, anything can become valuation at the end stage. So far as you can back it up, you can say, oh, I understand what this is saying. So if you come up with a series of what your valuation is, or what your pre-money cap or pre-money valuation is, right? I hope everyone is understanding this concept. Maybe I should have spoken about it during my session. So thank you, Faithful, for bringing up that question, right? The concept of the pre-money cap, pre-money valuation, and the post-money valuation, right? So when the investor asks, what is your current valuation? Believe me, you are not a real estate company. You are at any stage. All you have is your product, the markets, maybe not so much numbers. At that point in time, they are not expecting you to have a full show how the valuation is. Someone like me, who is a consultant, someone like me who is a financial professional, can pick that up and create a valuation, create a model for you. So that's how it really works. Because at any point in time, even if you are founded last month or in December, you have to have a current valuation. And that current valuation does not mean you have any numbers to show for it, right? I told you about the company I'm raising for in fintech. They want to raise $1.2 million. Was speaking to investors, connecting them to investors, and they've done 800K in 6 months. Now, that kind of company, the way they would value their company is very different from how a company like yours will do the same, right? So that's really how it works for most times, because they have numbers to show for it. You can ascertain their valuation. But for you who you are not in a traditional sector like fintech, anything can come to a valuation. But it's supposed to say this is how I think of it. At that point in time, investors call it a valuation story. You have to be able to tell that story. You need to convince that person enough to say, I want to come in, or I understand what this guy is doing. When one point, once proper we've got that first check, they are not made money. I don't know how many people. Is there anybody on the call who can validate what I've said, confirm? You know this before. Is there anybody on the call?
Yeah.
No. Okay. Once proper we've got that very first check of value of 50K or 100, they've not made ₦1. They've not made ₦1. But they were able to tell their valuation story, ascertaining the market opportunity, ascertaining you're in a creative industry, the gaming industry. What's the global growth rate of the gaming industry? What's the regional growth rate of it? What's the stay there? Capital asset, compound annual growth rate. These are things, right? When you don't have intrinsic numbers, I've said it countless in before. When you don't have intrinsic numbers, rely on the public data of the market. You can never go wrong. You can never go wrong. So that is where all this is come from, and that is where the interplay comes into place, right? And for someone like Peter, they're able to create the story of the valuation, convert it to a financial model and valuation analysis, and from there We were able to build up a full valuation from that early stage up to unicorn. So I think they only miss the year they hit unicorn, right? They should have probably done that 6 months earlier, but that's not bad. If you already have a roadmap or something, if you miss it by 6 months, it's not bad, right? So that's really how it is. What I'm trying to say here is, when an investor asks what's your current valuation, they're not expecting you to say we are looked at, we have our financial. No, just create a story, your IP, your patent, your gaming studio, the market opportunity. Come up with that and create it. Remember, I told you before, the Beckus method. Beckus method is the method that we mostly use for early stage companies. The Beckus method, nobody has made money. Nobody has done anything. An investor will just sit down and say, this is how I've assessed the market. This is how I've done this thing, right? And then you cannot now say, you cannot now agree. This is what it says. So at the end of the day, you as a founder, you might tell you before that you are the chief salesperson. You're also the chief picture, right? You can create your story. As far as the investor finds it makes sense.
Okay, there's two more
Yeah.
questions. I just want to
Okay.
add to it. Okay,
Yeah.
so the question now is bank statement and financial record really important? Because I've done a lot of research and knowledge hunt, and I found out that getting a financial record can really help to improve and back up your current evaluation in the whole system. Like, for example, if we're looking at, just give me a second. So, for example, if I'm in a meeting, and for example, I'm really sorry for the disturb. While we're trying to get all of our expenses in place, we couldn't get all of the records in check, especially the bank transactions for some of the expenses we're paying for. Like, for instance, we had to pay for some artists in Brazil. We don't have access to pay them. I have to get a third-party person to pay them. Are all of these records really necessary to get a good company pitch deck, or can we skip the whole bank statement and records? And so that's one question. The next question, you talk about the post-evaluation. Can the future evaluation of the company, is that the same as the post-evaluation you talked about? Because on our pitch deck, we have our estimated evaluation with a minimum and a maximum cap in a period of 7 years and a maximum of 6 games. And a maximum of 6 games. So those are my last 2 questions.
Ayo, before you go, right? Ayo, before you go in on this question, Faithful, I would also want you to tap into some of the experience from Jide Martins around maybe something similar to what we're doing. I know he's spoken to a couple of people, and he might be able to direct on that industry. I would also do some conversations or opening conversations with someone who used to be at Unity, who is a very close friend of mine. And she's a gamer as well, to help you look into maybe what you're telling in your deck might not be the right things that maybe people within that gaming industry want to see, so that might also affect. Just wanted to chip in this, but I will let Ayo go in on that. And Jide Martins, and if you want to come back and have a conversation around this, it's an open floor. It's a learning ground for everybody.
Okay.
I don't know if I should let Ayo go first.
I think you should go first because Ayo is going to come from all the financial blah blah blah. But if you build the foundation for the conversation, I'm sure that Ayo can plug in whatever these conversations are together.
Okay, I'm just going to say something simple and keep it. It's a numbers game. So this the straight and simple answer to that from a creative to another creative is yes, you need all of your data. Yes, there's no way around it, right? If you don't have that data now, then it means you don't have that data and it's a disadvantage, right? You need as much as possible to put things in place where you have all of your data necessary. So if you pay an artist, and it's pretty simple, right? There's you can keep records on how you pay. So, for example, what we do, no matter who it is, the accounting department has to request a payment, has to get an invoice, and then we have to make a receipt, no matter where we're paying from. And then we make sure that that payment is documented and it's also paid from a central company account. And when I say central company account, you can have a DOM account in different countries that's all tied to one account, or a DOM account in the name of the same business in which you're running, as long as it proves that you paid from a company account or from a business account that comes from the business that you're running, it is necessary. So bank statements, bank details, accounting details are very crucial. You're asking people to invest their money. They need to see how you spend your money. I think that's the only thing I'll say on
Okay.
that.
Okay, but the thing is, can we make a statement that is not under the company's name? Just I make an example. I was trying to make some payment in Brazil, but trying to use our dollar account, we had so many challenges to make those payments and all of that. So the easiest way we used was PayPal, which we couldn't even get it to run freely and seamlessly here in Nigeria. So I had to use someone else's PayPal outside Nigeria to make such payment. So would it be proper and professional to bring those records while it's someone else, or should we generate a receipt, like an invoice under the company's branding to do as a documentation?
Yeah, as long as you can show a trail, if you ask me. So, for example, if you're making a payment on behalf of your business, there needs to be an email that says, oh, this is how we're going to make the payment on behalf of the company, probably from the company email. Is how I would handle it. And then, of course, you really, really need to try and minimize those, because again, you're going to ask somebody for money, right? And so that person has to be comfortable with you. It's a problem that we creative have, where we believe that they need to believe or we've done enough. No, the onus is on us to prove to the person that we're trustworthy enough for them to give us money. I'm trying to break it down to everyday terms, right? So you need to have evidence that you are running and you're managing your funds the way that you say that you are. So they really can say no. You need to have that in your mind. Say they can easily just say no. You need to prove that you made that payment. So, for example, before I make that kind of payment, I will send an email to say, we can't make it from our official account, but we're going to make it from this. And then make sure that there is some kind of transfer or evidence, because again, you need to pay tax, or you need to make sure that that person is paying tax wherever they are from. So because of all of those technical things that would save the investor from risk, right? And to also show that finances are being handled properly. You need a trail, you need evidence, you need to prove that that expenses was made for the business that you claim that it was made from. I don't know if that makes any sense, but I'll stop there. I'll allow.
Yeah, I think it makes sense. For the email, yes, we had an email to let the clients know that we're not making payment via our platform, because most of them actually sent a request to our official email for payment. And you also talked about the record. Yes, we have screenshots, records of the payment as well. Yeah, so we had those two things in check, and I feel okay.
I think the answer.
So, but in record,
I think the answer to this, money always leaves a trail, right? That's why it's very important to keep that trail. I want Ayo to answer this question, so Ayo can, just give us from a VC standpoint, if it's a red flag, not to have those things that Jide is saying, and if having them doesn't also look like, because of course, founders can be funny. You can also be laundering money in that regard. Somebody else is making a payment on behalf of you, but you're laundering the money. You're taking company's money and rolling it into a circle back to yourself, right? So I will leave you to do this conversation, because we've seen this happen in the startup ecosystem.
Okay. Thank you, Jide. Thank you, Ayo. Thank you, Faithful, for this. I'll just recap everything and I'll just share my own experience. I used to work for the and we faced this on 2 occasions. So we're speaking to a founder, nice valuation, nice product. We really wanted to come in that round. And the founder was saying that they have some partnership details that were not in their financial revenue, is all discounted and all that. And then the partner on my team was like, okay, let us see all your partnerships. And then he said, no, you can't show us. And we pulled out of the round. We We didn't need to go back and forth with him. We didn't need to explain why we needed it. The first no is the first pull out. We just do that. Let me explain why. Investing is trust. Whoever is investing in you is your growth partner. I say this all the time. See, share everything. I promise you what is relevant and what is, you don't even decide to, you don't get to decide what is relevant. Share everything. You are coming to an investor like an open book. And I think that is what a lot of founders miss, or a lot of business owners in that space, right? A lot of founders maybe forget that you have to come in like an open book. You don't get to decide because you are receiving investment. And part of what can be used to ascertain investment readiness is openness. If you understand investment readiness and openness, I'll give you another example. And that's what, as a founder, please ensure that any money you are wiring, any money you are, especially if you are an African founder or a Nigerian, right? Make sure nothing is in cash. I'm pleading, yeah. Make sure nothing is in cash, right? It's similar scenario I gave you. And the founder I was advising was going to receive the investor about 2 million, right, in USD, and then the investor says you want to collect in cash. That's already a red flag. One another investor was going to come in on the round. Now this raise, they try to raise an $8 million, and other investors are investor because you have to track all your transactions. Remember, I think now, if I'm going to be the financial model for valuation exists, remember that I'm going to model your income statement, your balance sheet, your cash flow. I don't do that. I'm not the Holy Spirit. I will use your financials. Your financials, I'll use your bank statements. I'll use. How are you spending money? That's that. I need to look up a store or anything. That is the major source. And you have to be able to consolidate every transaction, everything you are doing in your financials. It is not directly related. There has to be, and that's why I say it again, don't receive money from anybody in cash. Don't wire any money in cash. Make sure that everything is really done. So this is just like the, I don't know if anybody has said this before, but it's like the open, there's a global alliance for VCs. We don't, where VC do not speak to you, if you are talking about conversations in cash, right? Because especially in Nigeria, a lot of startups are doing this. So at the slightest suspicion of if you are trying to hold back information or saying something is not, or something cannot be ascertained, any VC will pull out, right? So that's just to answer your question.
All right.
Make sure that all your, let me just wrap up. So make sure that all your transactions are ascertainable and traceable. Even if you're not paying directly from your account, send an email. That's like what they said. If I'm not going to pay for my business account to anybody, I send an email. Oh, I'm going to use this account now. So that everything can be traceable because anything can make you lose your license. There's a startup that lost their license, and they just got it back after like 7, 6, 7, 8 years. It was just a mistake from one of their customers, and we put them in trouble. So if there's any founder here for your business, don't do in cash. And just answer your question faithfully. You can go to, if anybody's going to, if you're supposed to an investor, your model, your valuation, your bank statements, your partnerships, everything, because you're coming like an open book, they're giving you their money. You don't get to decide what you share with them. I don't want a situation where you have shared everything in your data room, and then investors are asking what of this. Oh, we have this, I'll share with you. You lose interest immediately. So at the first person, you don't want the last conversation anybody should be having is about whether they trust people their money. A lot of founders in this ecosystem are brilliant founders. Brilliant guys, but they've gotten their hands dirty and nobody wants to be involved. So you want to avoid that totally. Yeah.
Okay. Mr. GD mentioned something which I felt, I don't know, Ashon or shared if that's like the right approach. She said a lot of people have been using this, a lot of stuff, startups have used it as a money laundering system where they put in money, bring in money back. So my own end, I was thinking, okay, if that's how they do it, in my own record, I can categorize everything into projects. So every money that's been spent has a corresponding project which have approved. So for instance, we spent some money to pay for the assessment when we did our 2D artist outsourcing. And now there's a proof for that because we paid them for their test and they presented an asset for those tests. So in such scenario, it's difficult to say that was a money laundering because we have the proof. So I don't know, but I feel since that's the way, it's better we categorize all of the expenses into projects. I don't know if that's a good approach.
I think that we can take these conversations offline, Faithful. I can link you up with Ayo and then also Mr. Jide so that you have an idea of.
Okay, thank you, sir. I'm really sorry for wasting
No problem.
Yeah.
It's fine. You're not wasting our time. What the essence of Umbrella Saturday is to have real time conversations. Definitely.
Yeah, thank you.
All right. Yeah, but let's have Emerson. I know I've asked you like 3 times. I hope you are able to speak this time around. If not, Remy, you have the mic.
Okay, am I audible enough?
You're audible now. We thank God.
Thank you so much. First of all, I would like to say, Ayola, this program, this platform is so this is like a gold mine that I have found. Thank you for doing this. And the conversations are so top tier. I've been taking notes all through. And so I'll just go straight up. I have 2 questions. The first is that I hope that this recording will be maybe put out so that we can revisit it and get some more information. And then secondly, which is my main question. So I am the founder of Shukovas. It is a digital it's a digital platform that helps educational institutions to issue digital certificates, secure and tamper-proof. Now, we have our MVP, which we are going to roll out soon, and we have pilot partners, which are boot camps and some educational institutions across the continent in Kenya, Nigeria, and Ghana that we're going to use as pilot partners to roll this product out. So this program just came as a timely, like very timely for me. So my question now is, since we are rolling out this MVP with pilot partners, what's the best strategy to have, and what are the must-haves that we should have in terms of financial model? So that's my question. I don't know if you got that.
Are you here? Ayo, you're muted or if you're speaking, you're muted. I hope we've not lost Ayo, right? I see him. Oh, all right.
No, you've not. I was trying to, it seems like sorry, give me a minute, please.
All right. All right, Emerson, let's just give him a minute. I think he's trying to switch his network. I think network is bad.
Yeah, same here.
I think it's raining in Lagos if you're in Lagos. I don't know about the guys in Abuja, but maybe we might have someone on this call solve this rain issue.
Okay, but sorry, I was using my phone's Wi-Fi and it kept coming in, so it kept fixing. So just to say, before I go to your message question, I wasn't sure I got all your questions. So if you can just summarize up, it would be nice. I just wanted to say that if there are any founders to speak, consult, anything, please reach out to me. So help as many with education, help as many with analysis, help as many with readiness. I think that in this market today, like what differentiates a founder that is, it's not because one product is better or one business model is better or one is stronger. It's investment readiness. And all the factors or elements are investment. It's what we have discussed before today. Yeah. So, Emerson, did you kindly recap your question? Like, just summarize, maybe 1, 2, 3 bullet points.
Okay, so first, let me start with what we do. So we want to be the platform where, or we are building a platform because we have an MVP. We are building a platform where educational institutions come and they issue digital certificates to their students. These students can always show it off anywhere they want, whether on social media or wherever, but it can always be verified by employers or anybody across the world through our platform. So that's what we do. Now, secondly, we have pilot partners that are in Ghana, Kenya, and Nigeria. That's a bit spread out, I know, but a bit spread out on the country, on the continent. And since we are going to be operating with these pilot partners across the continent, I want to know what is the mindset to have or strategy in terms of the financial model and investment readiness. Like, what's your advice to a startup like this? So that's basically it.
It's not different from what I'm saying. So at that stage, we have to factor in. And what needs to show is strategy, a good strategy, a financial roadmap strategy, right? And then that is what trickle down to a financial model. Because at that point in time, it's still we want to. So what's the plan to get there? What's the roadmap to make sure that you're there and all that? So once you can cover that, right? The metrics, pain points, or elements in that roadmap, in that strategy that you have, to what we can combine whatever financials you have or whatever data you have to build a financial model. Because even then, we have a tab that shows the strategy to get here, strategy to get, right? Where you are looking at, oh, we want to achieve this. This is our how. We
Yes.
have achieved this. This is how we want to scale the next. Because the market today is all about the market opportunity, scalability, sustainability, right? So at every
Yes.
point in time, it comes to everything. When you say we want to, the first question that comes to my mind is how to show them why we have, like, why is this your strategy at this point in time? Where, and that is where you should hinge a lot on the market opportunity. They are tapping into the market opportunity here, they are tapping into the market opportunity here and there. Then you say, oh, how? How are you doing it? That's the strategy. How are you going to get there? And at that point in time, we are not, we as consultants or whoever is going, we will now triple that into numbers, right? Because we as consultants, we work a lot with guesstimates, right? We work a lot with a lot of these things, but respect our assumptions. We do a lot of assumptions, but we can back it by something, right? When can I expect? But see, a lot of people that raise money today, most of them will have an exit strategy. They'll tell the investors that we have 3 exit strategies. List on stock exchange in 7 years. Acquire stock or get acquired by the other player. The third one is eat unicorn. So they already show you, and there are practical steps to how they will get there and when they will be there. Is it a 7 to 10 year timeline? Say 5 to 7 years timeline. So that's really what it is. So when the question comes up, once we still want to achieve this at the start of, it means that you're now saying, what is our strategy to get there? How are we getting there? Yes, and when we get there. So that's really what it is. Did I answer?
All right, thank you, Ayo, thank you, Emerson.
Yeah, I hope there will be an opportunity to take this continue this conversation offline.
Yes, we're going to have a breakout room where you can actually ask him more deeper questions than what we have currently. It's called the deal room. It will be open soon. It will open about 12:30. So you can ask him that question or deeper questions, more relatable questions there, and then he will take you through what they do at board in the deal room. I saw Remy's hands up, and I'm not sure if I also saw this. But before Remy comes up, let me just read Anne's question, or Obode Anne's question. She says, how do you value a business that is not a software company, especially when you are starting out and what is the best way to raise funds since VC are looking for high growth companies? I would also add high potential companies, not just growth. So Ayo, you want to answer that? Ayo, I think we're losing you. It's not clear.
So how do you value a company that is a software company? So a lot of software companies are valued on very, very high multiples. Right? Value like tech companies or fintechs, valuation multiples that will go as high as 22x, which are even very, very which can be a risk of being overvalued. And that's because the market opportunity is very exciting. Right now, for traditional for a lot of companies that operate in the ecosystem today are building on technology, right? So they are building solutions that are using software, agri-tech, food tech, fintech, buy now, pay later, all that, right? Now, the best way to raise funds here is to look for target investors, right? The investors who look for companies like yours, right? Because now, the reason why I try to explain that valuation multiple is because high growth companies get higher valuation multiple. And higher valuation multiple means that they can raise at the higher valuation. And it is an advantage for individuals to invest at the higher value and get returns at the higher valuation. Right? So that's what it is. But for traditional companies or non-software companies, it is more conservative, right? And I'll be truthful with you. If you're not building on software, it's hard to raise this money, right? If you're not, so the idea is just to build a business. Because if your business does not run on software, then it's an SME or normal traditional business and all that. Where you now need to scale for nothing to 5 years and then after 5 years, it's right? But for VCs, they look for moonshots. Moonshots are like short within a short period of time, improve within a short period of time. Just how I'm saying, so like a lot of companies that are building using software, either software as a service or banking as a service or SaaS or BaaS, fintech as a service, and anything, right, are able to tap on that software approach, especially in its evolving, technologically evolving world, and then be able to say, oh, all that helps them get try fintech. You now get very high multiples, and that becomes like a high growth kind of stage assessment, right? So that's what it is. So strategy to do that is to look for investors that are target investors. So that's what we as promoters do. We do the work of sourcing. So we source, we don't just go to an investor and present deals. Go to the investor who is looking for that sector because they already have their thesis and that sector with general assessment, like what software, whatever, argue, not really terrible. So more like impact investors. Yeah, that's it.
All right, thank you, Ayo. Let's have Remy. Remy, I know your hands were up for the longest. Do you want to quickly speak?
Yes, thank you very much, Ayola. Apologies for the lack of decorum earlier. And thank you, everyone, for the questions. I've been noting down things from the answers and the perspectives you're sharing. Like I said earlier, we are an ISP, and we are in the process of raising pre-seed. We have spoken with a few angels, and we've seen that in some of the angels we spoke with valued us based on the cash flow that we have at the moment. And we are trying to show that right now our balance sheet is at negative because the family and friends we raised was a loan, so it's on liability, it's not an asset.
Aya, do you want to speak? Or I said, Remy, are you still there? Are you still speaking? I know you went quiet for a minute. Hello. Hello. Sorry, let me close our room first. Let's close our room. Apologies for that. I'm just trying to get ready that room. Where is everyone? Please, can we just come back? Sorry about that. I think I opened a room. Sorry, I think that's my error, guys. Apologies for that. I opened the room earlier than I wanted to. So let's everyone just come back. The room will close out soon. Remy, apologies for that. Just a minute. Let's get Ayo's back here. Ayo, are you still here? Sorry, everyone, for that. I think I moved us earlier than time. It was supposed to be me getting ready for the breakout room. But Remy, sorry, I don't know if you finished your question. Do you want to just quickly recap your question? Sorry about
Okay. Okay. So we are an ISP. We raised a small, about 5K to set up our MVP. The model is designed to serve a 200 users on the COGS, reaching margin of about 75 to 80%. Currently, the service is serving about 30 users on the same amount of COGS that will require to serve 100 to 200 users. So our profit and loss statement is on negative because we took a loan. Our balance sheet is on negative. And the team doesn't exactly have the bandwidth. I am an engineer, but I studied some accounting. So for the past 2-3 years, I've been preparing the financial statements and doing the trial balance and all of that, putting the statements together. However, there are certain principles I seem not to know. Like when we are reinvesting hardware in the projections, we currently are showing projections that just by raising this pre-seed within 3 years using term loans, we'll be able to reach $1 million in annual recurring revenue. And of course, TZT, one of the players within our ecosystem, is going to be one of the first startups to IPO. That I think is part of the story. But angels are currently trying to value us based on our cash. Our books are negative. We've only made 1 million, things like that. And we are trying to help them see that if we raise this cash at this post money within 12 months at this deadline, we would actually prove the valuation because of the amount of cash flow we'll be generating at that point. But with angels, it's not landing. With VCs, we are going through due diligence and the conversations are stalling. I can't exactly tell what parts is missing at this point. So how does a company in that kind of situation, the revenue is in negative, you have nascent product market fit, you are capex heavy, how do you de-risk that investment for a VC or an angel?
For that kind of business, right? Because of the business model that's capex heavy, capital intensive, and all that, it makes sense to raise venture debt, right? It makes sense to raise venture debt for that kind of business model. Look at it, they were able to scale and all that, and now they're able to attract equity because they've been able to become cash positive, right, and sustain it over a period of time and be able to hit sustainable profitability. So I think an approach should be based on what you've said. It might just be to raise venture debt because you are paying back, and that could help you achieve some sort of sustainable profitability and move into cash flow positive or you can approach investors now. But equity investors would necessarily not want to come in at this stage. If I'm going to be truthful to you, because of the impact of the state of the company and the trend on the valuation itself. Yeah.
Thank you.
Thank you. Go ahead.
We have spoken with a few banks, and the terms for venture debt is having VC or an investor's confidence. So if you've raised money, you can access venture debt. So it's like a catch-22. You have to do this to get that, and you have to do that to get this type of thing.
Not necessarily, but yeah. Okay.
I think I'm not saying something. I'm looking for my blind spots here so that we can approach this thing properly.
Yeah, I understand, Remy. So like at that stage, if you go to banks anyway, they like to see collateral, so they want to see investors confident. But there are investors who invest venture debt. They will not have a lot of stringent because they will understand the state of the market and all that. There are VC investors who
do debt.
Yes, who do debt, yeah. They will be a better option for you. Sorry, at this stage, I don't even advise to approach banks at this stage at all. Yeah.
All right.
Thank you very much.
Thank you, guys. Ayo, I'm just going to touch on two questions. I hope you're able to answer them before the time for the deal room starts. Am I seeing new questions? Okay, no, just people chatting and giving their stuff. All right. So in your own experience, Ayo, what are the red flags that makes investors push down a founder's valuation, and how do you undo those negotiations? I've not heard anyone speak around that. We're speaking about the valuation, but let's say the valuation is great. How do I negotiate when the investor is pushing my valuation down? I've done all these things Ayo has said on this call now. Right? I have perfected it, everything is valid. But the investor is now pushing down my valuation. How do I approach the negotiation?
In approaching that negotiation, remember that for investors, they want to come in at a very cheap valuation. So it is natural to expect that they will push down, right? This is just very natural. It's not hard to explain anything. So how you can approach it is helping the investor understand why pushing down your valuation will not work for your business and for the round. Especially if you have other investors who are coming. So that's the leverage you have at that point in time, right? Oh, this is the general round details that we're having, using notes, using this, using that, wherever the investors coming in. So pushing down my valuation would distort the agency or expectation of the round itself. So if an investor is pushing down your valuation, it means they are already interested. They just want to push down a bit and see how much more stake they can get for their check. So that's the way to approach it, using the leverage from other investors who are going to come in or have come in on your round. And if you have a pushback on investors, a good idea is to reach out to your lead investor. So in every round, there's a lead investor who primarily engages all the other investors, is your biggest believer anyway, has the most check in the round. I think $1 million they had invested 400 or 500K. So it makes sense to, because they have their highest stake, so their interest is higher than anybody else. So come from an approach of how that negotiation will affect the general round itself. At that point in time, other investors would prevail, or even the investor can come in. Yeah, that's a good way to look at it. But I'll just let you know that it is natural for investors to push down the valuation. So how you want to approach is helping them understand how it can work, and if it doesn't really work, and always walk away.
All right, Ayo, thanks so much for that. I have three more questions, follow-up questions. I know I said two before, but three more follow-up questions. What's more important in a pitch, right? Telling a compelling vision or backing it up with current metrics for valuation purposes? What's more important?
Backing it up with current metrics. Yeah, remember that we talked about practicality. right? Yeah. So let me just give you the analogy I gave you for this year. So when you say vision, vision is something that would still need to control. So at the end of the day, you need the correct metrics to achieve that vision. So it's rather to push forward the correct metrics that you have to make the conversation practical and sort of feasible for the investor. Yeah.
All right. Thank you, Ayo. My last two questions, right? And I hope we're all still learning. When it comes to, and this goes to equity and dilution, right? Just some conversations around that. At what point should a founder prioritize high valuation versus finding strategic investors who add value beyond money? At what stage?
Like yeah, there are always roadmaps. Seed stage, you need to scale your product. Pre-seed, you need to raise money to create runway. So by from that your post seed, you're now looking at strategy, scalability, and all that. That's where you begin to choose your investor. But at the point where you just need to scale the product, you just need to get some runway, you just need to. I mean, you should still assess your investors, but it's more important at the post-seed stage, where because crossing over, a lot of startups struggle to scale from post-seed to series because the valuation metrics are 10 times more, customers are 10 times higher. You are dealing with 10 times the devil or 10 times the demon that you used to face in pre-seed and seed. So yeah, that's the point where you need
Ayo,
that kind of thing.
can we quote you on X and on other platforms that you've called investors demons?
No, I said like when I say demons, like the entrepreneurship problems that you face, the kind of problems you face in proceed, seed, you're facing them 10 times. The money you raise from investors is 10 times, right? So at that point, that's what I mean by demons, the entrepreneurship challenges that you face, basically. Yeah. It's always like 10 times. It just feels like you are crossing from 10% to 100% in one go or in one round. So it's hard to keep up momentum in that kind of state. Yeah. So crossing from seed to series is always very challenging. And that's why you need
All right. All right. Ayo, this is my final question. And this goes to long-term thinking. How do you balance raising at a high valuation now versus the pressure that creates for the future? How do you balance it?
and yeah, it's just more about like when you raise at a high valuation, it means you have diluted your stake more, right? So it means that there's going to be very much pressure. So when you don't get it right from the onset, it becomes a very big problem. Maybe like your seed state or your series state or even IP yourself, right? So it's good to get it right. It's good to raise at the very because the advantage is to the investor, but it's advantage to you when you raise at a high valuation and the investor is able to get a stake at a cheap valuation and all that. So it's good to avoid it totally. But in a situation where it happens, you can do a lot of renegotiation of stake, right, with whoever the investor is and all that. But it's just good to avoid it totally because um, it's hard at that point in time. Yeah.
All right. I don't know if anybody has extra questions. Jera, I see you on this call. Nice to have you here. I don't know if you have questions for Ayo, but in the absence of any additional questions, I would open the board D room where Ayo just talks more about what he does practically with board. Gerard, okay, you want to say something?
Sorry. Yeah, just quickly. Thanks, AY, or rather Ayo. I have a lot of friends, Ayo, so usually call them AY. So I heard, there was a question. One of the first question I was asked in the last three questions was which should the founder focus more on? Is it backing up in the pitch, backing up it with stats or selling the vision? So I think it's based on the my opinion anyway, is based on the investor one is speaking to. So I do know that there are startups that have raised huge amount of money without any traction, but they sold the future, and they saw how big it is or how big it will be, and then the market size and every other thing, and they say, okay, they better cash in on this now before they lose this opportunity. However, for investors who who prefer to put money down or write a check based on traction, they want to see what you've done. Of course, those ones at the end of the day, they know that their margins would not be very large as compared to selling the vision. So I personally, if so, there are two kinds of investors here I've spoken about. The ones who want to play safe. Everybody doesn't want to see through their money in the, even if you have invested in the vision. But I'd rather pitch the vision personally than focusing more much on traction. So the would be, if I could achieve this, how much more will I achieve? This is where I'm headed. This is where I'm headed. So end of the day, the selling the vision, selling the story, they see 5 years time, they see 10 years time. It paints the bigger picture of where, and you won't differentiate yourself as everybody just wants to raise money, everybody wants to just doing the same thing, and then there's really no significant improvements, except maybe just a change of name, change of color, or stuff like that. So the vision is where the work actually is. How different are you from the next person? Yeah, you can be doing the same person with 550 other startups, but your cash flow is quite high. But what's the vision for you at this point? Is it what are you selling? What are we looking forward to in the next X years? So I think many people fail out on that because there's actually no significant vision for them aside from the now. They just want to edge more markets, reduce pricing so that these other people will come to them, take their customers, and repeat the process, and then go online or tell investors that, oh, they now have X number of customers. But guess what? A Chinese company will come and do that same thing, slash the price by 75%. And the same thing happens to them. That's because they didn't set out an actual vision for the company that investors are going to sell to. If you look at Amazon, how these guys built, even Mox, how they built, they always sold the vision. People saw the vision and invested in it rather than focusing more on traction. So again, based on investors, I would say, and if the company won't actually has a vision.
All right. Ayo, you want to respond to Gerard? I think it's a balance, is a cash 24. Balance it, find a balance between two of them, know the investors you're speaking to. We always say that sometimes do your own due diligence on the investors, know their investment thesis. It would help have a better understanding. Thank Gerard for that addition. Ayo, you want to?
Yeah. I just want to say that yes, it's all perfect. You can have a blend of both. If you look at the PayPal, Elon Musk, I can't remember his name right now. A lot of guys, right, is be able to sell the vision of an understanding of where the market will be faster enough. Like they could show a mental picture to the investor, and oh, I want to be part of this, right? And that works, right? But in a situation where you have to choose one, and that's why it's important to understand the philosophy of the person you're talking to. Does he have a track record of investing, of taking big bets, or is he one that quantifies the traction and the growth first? Right now, if you are building a situation where it's a fast growing industry and you might want to pivot later and share that vision and all that. But it's always been a good idea if you can share both, right? The company I'm raising for has perfect traction and their vision is also very strong. So any investor would definitely want to drop on it, right? But like I'm just saying that if you had to pick one, shout out to an investor who's trying to make a decision, it's good to there's this thing the can't remember right now, but you say something like look at how far you've come to be able to ascertain how far you want to go. So in a situation where like
a investor wants to make a decision, it's better to show them what you've achieved. Right. And then when they are sold on it, and I also talk about the vision. But yeah, it all depends on the philosophy of the investor. But I know that in making decisions for a lot of investors, it plays a part because at that point in time, it is helping them make a decision on they want to write a check after they have done their own returns analysis. And that's metrics they will use. Right. The vision is good, perfect. Right. Yeah, it depends on the philosophy of the investor, but it's not something that can be quantified. Right. It's at the end of the day, it's just the projection. And when you have your own very strong vision plan on vision board, it's always very good. But at the end of the day, to help you really make a decision, it's always the metrics. Yeah.
All right. Thank you, Ayo. The deal room will be open now. So we can join in. Please, let's just join in the deal room. All right. So let's have more people join in the deal room. We can just quickly do this. So Ayo, how the deal room runs is that you just let us know more about board. If you want to share up your screen to show us board websites, how can founders access it, share more details into how they can reach you. Some founders might have some questions around helping them out with their financials. So I think it's like a great space to just, share more information around your products, which is bought.
All right. Thank you for the opportunity I allowed. Just going to share my screen right now. Share. Okay, sharing is not turned on. Please check that.
Let me do that. Let me just do that. Can you try again?
Okay.
I know you have to make a request to me, but I'm not seeing the request.
The host is not allowing sharing for this meeting.
Okay. Just give me a minute.
Yeah.
Let me grant you access to it. Okay, Ayo, maybe you might just need to. I really can't figure that out. So I don't know why that's not giving me the abilities to share with you, but okay, all right. Sorry. Ayo, try now. Can you try now?
All right. Yes, I'm going to figure it out.
Great.
Thank you.
Thank you.
Yeah. So can everyone see my screen?
Yes, we can.
Okay, great. So it's been very good to speak to everybody on the session today. My name is Ayo Akindele. I'm principal consultant at Board Consulting. Board Consulting, we do business advisory. Board is a strategy consultant and advisory firm dedicated to early and high-growth entrepreneurs across Africa and other emerging markets. We provide technical and financial due diligence to investors. Now, we've been able to have a sector coverage across consumer retail, fintech, payments, climate resilience, agribusiness technology, AI and blockchain, manufacturing, identity management, digital lending, logistics, as well as infrastructure advisory, that's mining and extractive industries. Now, what do we do for our clients? We work a lot with startups. So our customer segments are startups, corporates, SMEs, traditional businesses. So that's our 4 customer segments. And 80% of our clients have been startups. We've been around for about 26 months and we've done about 20 clientele so far. Right. We ensure our clientele achieve success for their critical projects through strategy consulting. So we do things like corporate strategy, business plans, go-to-market strategy, revenue growth strategy, market intelligence strategy, execution strategy, product market fit strategy, and even fund advisory. And then for financial advisory, we also do like fundraising. We help companies raise equity and debt. We do financial modeling, business valuation, which I spoke about today. So everything I spoke about today is what I do for work, right? So if you're looking for a consultant to help you figure these things out, I'm your guy. We also do financial analysis and personal appraisals. So how can you reach me? Let me go to my website. So this is my website. It's called boardadvisory.com. The B is in block letters. So boardadvisory.com. Let me type it again. So it's so there you go. So so our board, we are helping founders path to growth straight. We provide strategic consulting, venture capital raising, advisory, and operational readiness services to early stage startups. We also work with growth stage. So if you want to reach out to me, you can book a call here and have a 30 minutes conversation, to understand your pain point needs and all that. Right. A lot of our clientele here that we work with auto spend, one value, then time phone, about 20 of them. So we are private consultants. We provide we are into startups and business advisory, where we provide strategic consulting, capital raising advisory, and investor readiness. So investor readiness, modeling, valuation, preparing data analysis, and all that. I can contact us, I'm going to call here, right? It's very user friendly. Our services, right? Startup growth, startup advisory, fund investing, market entry, fundraising. Now, all our services, view all services here. So we offer, so far we've done about client expertise, fashion, traditional retail, KYC, ML, fintech, payments, financial process, climate tech, financial advisory. Now we offer student growth, advisory, financial analysis, fund advisory, and financial due diligence, market entry intelligence. We do capital raising, we do financial models. So our financial models offer detailed projections and scenarios. So we build scenarios in our own kind of models. What's the best case? What's the best case? What's the worst case? You are helping investors understand the best case scenario of your business based on like macroeconomic factors like inflation, FX, regulation, business valuation. Just helps us understand true market value for projections, versus planning, investment appraisals, business planning. We also do all our market research, right? Yeah, our team. So that's about us. You can also chat to us and just like so our clients so far, about 20. Been around for 26 months now. Doing about 20 clientele. So as I said before, the best way to reach me, you can book a call here. Text is my calendar, and we can talk. The aim is that when you book a call, you have gone through everything I showed you here. You understand what I'm speaking about. So 30 minutes while it's like understand your pain points, what you need, our pricing and start works. Yeah. So I look forward to engaging as many as possible. And yeah, thanks, Ayo, for the opportunity.
All right, thank you. I don't know if anyone in the room has questions for Ayo regarding the services they offer. You can just unmute your mic so that we can have the questions. Any questions for Ayo? I see you unmute your mic. Do you want to speak?
This is great. I wanted to ask if I was going to be back another time because I do have a lot of questions, but I can ask you another time.
You can actually ask him now, but yeah, he will be back some other time.
Yeah, before you go on praise, I already said it. We talked about creating analysis for creatives. I'm happy open to that. I'm open to speaking as many as possible and working with as many as possible that won't need my services and any questions you have and all that. Our aim at board is to help your path to growth straight. We know it's rough, right? So as much as we can help you just straighten that part and understand that it's all about investor readiness, right? How do you prepare your data room? How do you build a very sound financial model that any investor sees and already buys the vision and wants to come in? How are you able to show the different ways to value your businesses this year, because relative and all that. So that's really what it is. But I'll be open to taking more of your questions. I have a hard stop by 1, so let's all.
Yeah, let's see.
Hello guys, Osnachiko Leslie here from Gundu Games. I was even surprised to see a lot of my cool game devs here. It shows that we are really serious with this business. So I want to appreciate you guys for this call. It was very, very educative, and want to advocate more for what Jide asked for, that creative space where us as game devs and creatives can come in and understand the business of game.
I don't know if we're losing, let's see. I think that's me or my network.
You know,
I think we're losing you, Leslie. I don't know if it's just me. Ayo, can you confirm if you can hear him?
It's cracking on my end too.
All right, so let's see. Maybe I'll just mute you for a while, and then you might need to come back once your network is great. Do we have any other questions? Any additions? Anyone wants to add? I think Ayo will be happy to take that. But in the absence of any, I'm going to close the deal room, and then we can quickly just round up the session with Ayo giving his last words in the main group. So we can just quickly return back to the main group. Right. Okay. I think we're all coming back. We'll just give Ayo some time. Let's see, we lost you for a minute, but
yeah, Hotel did this thing.
All right, so maybe just wait for Ayo to join in. We're leaving the breakout room already. So thank you everyone for your time. Thank you for joining. Ayo, you want to give your last words on the session? So we can
It was good to speak to everyone about. I hope I've been able to discuss or cover all the gray areas as far as model and valuation. Valuation never ends. We all learn, even as the expert, I keep learning from engaging investors and all that. But one thing you need to understand is in startup world or businesses, it moves very fast and things keep evolving. Things keep evolving. There's never a traditional process. Things keep evolving. What works today might not work tomorrow and all that. And that's my job as a service guide as many entrepreneurs on these things, right?
So that when you build your product and scale it and everything, it can also help you understand that the business aspect can be very strong, but businesses will access your business, not even the products. Right? As very good as it is on the market, they will access it as a big.
Okay, I think we lost Ayo, but just to say that next weekend we're going to have someone from Scott Legal come take us on the legal armor for your startup.
Sorry,
I know you went out of the call. Do you want to
continue? Yeah, I'll just wrap up quickly. Thank you very much. Thank you, Ayo, for bringing me in. Very happy to. So, as many founders that in the umbrella community who ever need my services, you can also chat to me via the website. Like to chat to me to Ayola. I'm a partner with Umbrella. I'm onboarded as the partner, the service provider partner with Umbrella, and I'm very happy to work with as many founders. The aim of the work that we do, both Umbrella, Ayola, and myself, we aim to help founders succeed, right? That's the end game of the work that we do. We want to help founders succeed, and our arms are open, our doors are open. We want to speak to as many founders. I want to speak to as many founders. I want to work with as many of you who need that consulting. We need that consultants that can help you understand what's going on, right? Beyond even modern validation, you need to do some go-to-market, some market entry and all that, intelligence and all that. I offer those. So I look forward to working with as many of you as possible. And thanks again, Ayola, for the opportunity. I look forward to coming again to speak. Yeah.
All right, thank you, Ayo. Thanks everyone who joined the first session of Umbrella Saturday and also this as well. Next week, we'll be having someone from Scott Legal come speak to us around the legal armor of our business. All this sounds very interesting, valuation, raising money, fundraising, but how do you protect yourself from investors taking over your business? The other day, someone was saying something to me around Leatherback, who had a very great investor, and, some things didn't go great. And there's so many other businesses that you've seen that, at some point your investor starts to take over the business. I've also seen founders complain around VCs taking their ideas and running with. And what we want to do is to give you that legal structure that allows you know what to do and when to speak to your legal. Just the way you have fractional CFOs, some legal companies are coming up with structures that allow you not necessarily, retain the legal services, but use them on a per used cases, right? And so it will be great for us to also be on that call next week. Ask all your legal questions. At Umbrella, we've also seen situations where co-founders don't even have agreements. We've also seen where, you're going into partnerships and you're not even protecting your business, as little as that. And the end result of this is that you might also get into some danger with your business. Your vision might be taken from you in the long run. And again, also knowing when to take money is also very important. How long should you bootstrap, and when you get to that stage, what are the legal conversations you should start having? As creatives, people in GDA's industry, GDA, I see a lot of gamers here, Shei, Jide, Leslie, Lawrence, you're in the industry where your IP, your intellectual property needs to be protected, your concepts needs to be protected, a whole lot of things needs to be protected, patents, trademarks, so next week we're going to have someone from Scott Legal, who are partners with Umbrella, come on board, and we're going to be doing this frequently. I think next month we'll be having two VCs come tell us from their own perspective, what they look at when they're looking for high potential startups, and the red flags that they see in some of the startups. I've heard the VC say that some of us are building things that should be futures on existing platforms, and then we want to also raise for just the idea, so valuing your ideas, knowing how when your idea is good enough to scale is also very important. So I'll see you guys next week. I remain your host, Ayola. Hope you hear me. Gerard, I know you'll be there. Interestingly, Gerard, I don't know if you want to also just give a testimonial from your first session. It was very, very, very tough, very impactful hearing that from you when you said that you've joined communities and you've joined sessions. And Jide, I think Jide also said that today, they've joined a lot of these programs and, it's Aspire to Aspire, not in-depth conversations like we have when we are here. And then founders don't even hide their shames. We heard real stories from founders. So I don't know, Gerard and Chide, I don't know if you want to just give one or two conversations. I don't know, people might think you guys are my friends, but I met Gerard just like everyone. He joined the call and then he gave his feedback.
Yeah, thanks, Ayo. I was also looking forward to this today. Yeah, like I mentioned the first time, this is different for me because like I just get to listen to different points of views, which is great.
I think,
And
Gerard,
most
you should give them a
important,
background of who you are. Very important.
okay, I'm Jera. Founder CEO of Red Black Group. Red Black Group is a group of financial institutions. So we run a bank in Nigeria, we run a payments company in Nigeria as well. And then we also run a remittance/payments company in Canada. So we just call ourselves, we are focused on payments, remittance, and banking. Let's focus on payments, remittance, and banking. So, because we understand that these three aspects, these three categories are very, very crucial to people's lives. At some point, when some point in your life as a teenager, you're going to have a bank account. Later on, you're going to want to send money, you want to receive money from your uncles. So, we are caught in this space of at least one of three, if not three of three at the end of the day. So, which is why we are focused on these three industries or these three sects in this industry. So, what again? Yeah, that's just all about me. So, I'm open to learning, open to getting people's point of view, and I'm very, very especially open to visions. I love thinking. I love visionary thinkers. I really don't like, thinking just at now. I love how the difference. How is this still going to make sense next 10 years? Which is why I asked EY that question. Or my own point of view as to what I thought about what he said. Because end of the day, you could be asked that, okay, what if I give you this money and somebody else comes and just crash the pricing? What's going to happen? So this is where your vision, your actual differentiation now comes into play. People can't replicate vision just at the snap of their fingers. It takes years to even when they are replicating it, you are still moving forward. So and you leave them all behind. So looking
Yes.
forward to SCS.
Sorry, Jara, I'm sorry to interrupt. I just want to say I agree with you.
Yeah.
It's very important because remember that I said it at the beginning of my conversation that this is look at the long-term sustainability of innovation. Because there's a trend where you launch a very exciting product and then 2 years down the line, 3 years down the line, Microsoft, Google launches it as a feature. So, and that was why I also talked about the fact that in every VC looks for a vision statement of the fact that you are sure that you are building what the market needs, not just what the market wants, right? So that it can ensure the long-term sustainability when they are doing their due diligence, making a decision. So why that's why I mentioned that it's better to have both of them, show the metrics to help them make a decision and show the long-term vision. Even I'll give you an example. I'm sure we know Yeli of Microtransaction. Yes, of Onboard now. Now Yeli is an investor, right? He raised for Onboard. What they told investors that they were going to do is not what they are doing now. That's the funny thing, right? But when he raised money, they saw a lot of traction. He pitched a lot of, and he also pitched the vision. And when I was on the call with him, and he mentioned to me that he mentioned to the investors that he told them that he is expecting crisis in the crypto industry, and this is his vision. if he needs to pivot. So it was very easy for anybody to write in the check because they saw that, okay, this person is risk aware, is aware that there's going to be risk. It can't be rosy all the time, right? And when this happens, this happens. So that's why I mentioned that for you to get that check itself, it's a blend of showing your metrics, showing your traction. What have you done? But the vision also has to show that in case everything goes haywire, this is because I believe that in Africa today, a strong founding team with an average product will succeed. They will succeed very good. But a strong product with a weak team will cry. In fact, they will crash out at the first crisis. So that is what VCs look at when you're looking about like founder operational excellence and all that. They don't even look at the product again. Who's the person really building this? And so the personality of the person, the operational experience of the person translates into a vision. So that when the crypto upheaval came in, Geddy was able to pivot very quickly into on board, change the business model and all that. That was because he already had a vision, and that vision accommodated risk. That vision accommodated uncertainty. That vision accommodated things that they could not control. So that's just I also want to just add to what you said.
Thank you, Ayo. Thank you,
Yeah.
Ayo. All right, Gerald, you want to finish up? I know the conversation was your experience with the first session, and then the feedback that you gave. I know you don't like to be on calls like this, but I'm surprised to see you here today as well.
Yeah, it's like medicine now. It's like medicine to me. So I'm looking forward to the next one. And again, it's a topic I'm very, very interested in, legal. So amongst just a bit of what like really catches my interest is sales and legal catches my interest a whole lot. If anyone does a presentation about sales, I can't get tired because it's all about strategies, and strategies come about from creativity, critical thinking. And then how do you protect those strategies if they are somewhat of a like something new in the industry? So which is where legal now comes in. So looking forward to next week, and I hope everyone here will tell their friends, about this session.
All right, thank you, Gerard. Jide Martins, this is your first time here. I wasn't expecting you as well. I know you're a very busy man. You just raised money from Universal Studios. You want to tell us how that's going and what we should all expect, in this community. I see a lot of gamers here as well, from your gaming ecosystem. So I hope you're still on the call.
Yes, I am. Yes, I am. So first thing, I just want to say thank you very much again. I'm going to tell as many people in the creative space to be here because first, we're in an ecosystem that doesn't understand or appreciate the value in terms of how much it can actually bring to the economy and even in terms of our GDP. It's a $400 billion industry worldwide, and Nigeria and Africa is not tapping into it at all. And we have an emerging market here where we have youths who are really excited. They're investing. I don't want to start calling numbers in terms of how much games are making in Nigeria from foreign markets, and we're not tapping into that at all. So, and the key problem has always been that most people in this industry, I always say I'm proudly a creative, but I also know that the creative industry is not fast in the business side of things. And, even just being here, I have learned a lot, and it takes a lot for me to be impressed, but I'm very impressed about this session. So well done. Quality conversation, impactful thoughts. In terms of our deal with Universal, it's doing great. The key things I like to tell people is the fact that we still own our IP, and a lot of people have sold, and I've heard people say, what is the vision? And from the very beginning, for Comic Republic and myself was to ensure that we retained ownership of the IP, and then we gave out license to different aspects of it. And that has been a blessing in disguise because even though yearly we're getting license fees for different aspects of the same IP, we're still monetizing those IPs here. And, the future is, I'm looking at a future where I can share my knowledge and expertise and also work with other VCs and people who are interested in investing to build this ecosystem that the rest of the world, China is excelling in it, even India is entering the market, the US and Europe have dominated it completely. And Africa is the new emerging market that we can all, everybody in all sectors can smap the bank from. I think I'll just stop there and go on.
All right, thank you. Jide, I know me and we've had conversations around publishers taking, almost all the rights from gamers of the gaming industry. I'm going to bring you up on one of the sessions. I think I should hold you up to June or July, where we just speak about the business side of creativity, knowing how to put, of course, not sell everything to publishers. I know that a lot of gamers, they just develop the games and then they give it all to the publishers like Sony and the rest of them, right? So I would hold you up to a conversation around that. I'll reach out to you. Jera, I want you to also come around licensing. I want you to come around licensing. I know Uzo was on this call, how to navigate the financial terrain, how to work with SEC and all the other regulators within the environment. I would bring you up. Okay, Uzo, yeah, I'm sure you're excited to see that Gerard is going to come and tell you how you navigated it. How did you get into markets without the license and then later got the license? Did you start on the ground, get the users? These are conversations because of Uzo is struggling with, investors trying to invest in our business because she doesn't have the license. And if I got that right, but Gerard, I will hold you up to that conversation. What should she look out for? What kind of tier license should she get? Should she start with a microfinance license before she scales up? These are conversations I want you to also have with the guys in that market because you're doing something great, and I appreciate what you do. Jera, I want you to commit to it on this call, so I think I'm waiting for your mic to be unmuted, so I can reach out to you. At least you can even share some of your sales strategy that you've also acquired across board. It's Jera on this call. All right. That will be all from my end. I know he is committed. Whether he says yes or no, I know where to catch him. So I'll go look for him. Thank you all for joining the call. We'll see you again next week, where we would also be discussing something very critical, legal, and this is where. Okay, Sadiq, you want to say something? Sadiq, please go ahead. You're very muted. Your voice is very low. Sorry, I'm struggling to hear you.
Hello, can you hear me now?
Yes, I can.
I said you wanted us to discuss about the services we are providing.
To discuss about what?
You mentioned that when we started the call, right, that you want to discuss we are
I don't know if anyone heard you, but I'm still struggling, to be very honest.
I think he's saying when is he meeting with you? You promised to have a session with him.
Yeah. That's fine. That's fine. I'll just drop my number in the group. I'm pretty much accessible, but I'll just drop my number.
I'm not in any group. Are you dropping it here?
Yeah, on the chat here. I'm on LinkedIn. You can look for me on LinkedIn. If you go to the website, you click the contact number on Useumbrella. You're going to be speaking to me directly. I'm very much available. My colleague is on this call, Praise. So Praise as well is available. Praise, I don't know if you want to also drop your number in the chat. Praise leads our investment team. So you can also want to reach out to her. But yeah, my email, I'm sure you got an email from me, but I just also drop my email for anyone who is ready to reach out to me. Yeah, so that's it. thank you all for joining. Speak to you next week. I'll just give it some minutes, but of course you can exit the call. I'll give you some minutes so that people who have not saved the number can save the number, or you can do a screenshot and just save it up. All right, have a great weekend.
Okay, we are saving it. Just a minute, please.
All right, no problem. I'm here for a minute for those who do not have the number.
Useumbrella.com. Okay, thank you, please. 081 790 3956. Okay, please call Umbrella. Okay, thank you very much. I've gotten that.
All right, thank you.
I'll reach out for when we can get out of the call so you can tap in your knowledge.
Thank you. Thank you. V, we didn't hear your voice today, but maybe we'll hear your voice next session. Shay as well. Let's see. All right, guys. Have a great day. Bye.